Howdy, Team 42. It's your skipper here, Darius Dalio, to present another episode of Macro Bundle Live Q&A, our inaugural edition of 2023. I'm joined by Bob Elliott, founder and CEO of Unlimited Funds. How you doing today, Bob?
Good. Good morning. Nice to
Morning,
join
man. It's a great pleasure to have you. As you know, I'm a very systematic investor. Obviously, sort of spends my time being mentored from afar by your former colleagues over at Bridgewater. And so I just want to say thank you for a lot of the institutional insights that you guys have put out into the world.
No
Have obviously been a tremendous benefit for my career.
No problem. I mean, it's great to be here. Love following you on Twitter and squinting at the chart pack that you're willing to show us. People of the public
I appreciate
talking about
that.
markets. It's a lot of fun actually. It's a great vibe on Twitter. I'm new to it obviously, and you've been in the space for a long time, so I appreciate the warm welcome into the community.
Oh, very much so, man. Absolutely. Look, I like to surround myself, even if only, via from afar, with people who are much smarter than me and understand, markets at a higher level, the economy at a higher level, because ultimately that's how myself and ultimately our customers get smarter and get better. Just respect to a lot of the things you've been talking about on Twitter. You are, in my opinion, a breath of fresh air because, you and I were talking just now, I've always thought there was a big difference between macro and macro risk management, with the former being just like basically anything that isn't bottom-up security analysis.
Right.
And then the latter, all that stuff that actually matters with respect to, consistently generating returns in and across financial markets. And obviously in Unlimited Funds, you believe in the latter, and ultimately, to sort of, create a suite of products that'll help investors actually tap into that at low, from a low cost, kind of easy to attack wrapper. So, just give us a little bit of a background on what you're trying to accomplish at Unlimited Funds, and then we'll get into some more kind of ad hoc discussions.
Yeah. I mean, I've been, in the 2 and 20 space for 20 years. I was at Bridgewater for a long time. It's where I spent the majority of my career. When I left, I actually ran a $125 million venture fund as well, which was sort of systematic early stage venture. And my time, both at later years of Bridgewater and my time at in the venture side of the 2 and 20 space, increasingly recognized that 2 and 20 strategies, they're pretty good for the manager and not that great for the investor. And the reason why that is the strategies themselves are quite good and almost always, in a diversified way, beat the markets very consistently. The problem is the fees. And so the idea I had was, could we bring the sort of low cost indexing concepts that exist in stocks and bond investing, right? Which is, totally revolutionized those markets for a wide variety of investors, and bring that concept into the world of 2 and 20 to create diversified, low cost, tax efficient structures which replicate the returns of 2 and 20 portfolios. And so that's really what Unlimited is all about. I like to say, 2 and 20 at a quarter of the fees and half the taxes, and that's kind of the idea. And
that's a hell of a pitch,
right there. You go. And we launched HFND, which is our first ETF. It launched on October 11th, and it's been the number one independent, actively managed ETF launch of 2022. We got $54 million in it, which is going great. From
Congrats, man.
Basically from people who see the value of what we've created, particularly financial advisors, and just keep on going. Over time, we'll probably create more ETFs that replicate the returns either of some of the sub strategies like macro or equity long short, or build out a broader portfolio around other areas of the 2 and 20 space. So that's kind of what we're doing, and part of the reason why we got to know each other, I should say, is because part of my idea about Unlimited was not just bringing the return streams, making the return streams available to all investors. That's the beautiful thing about an ETF is, you can buy one share for $20, or you can buy, 25 million. Props to all those who want to buy 25 million bucks in it. But the other thing I noticed was there's just such a gap in terms of the availability of institutional quality macroeconomic understanding that's out there in the world and accessible to, to everyday investors, to frankly relatively sophisticated financial advisors, to
Yep.
small family offices. There's not enough high quality insight that's out there. And I think what we've seen over the course of the last couple of years, people like yourself have seen that gap and come in and started to deliver on that. And I think there is a ton of room to bring that kind of insight into the, to advisors so that they can help navigate what is, a pretty challenging market environment. It's a lot harder today, and the last year's been a lot harder than, any of the previous 15 for most financial advisors and investors. And so that's where macroeconomic understanding is so critical in this period.
It's 100%. And you're spot on in terms of our, kind of our bro fest for each other, which extends to the gridiron, extends to the gridiron as well. But I liken it to, because I've long had this sort of, kind of thought process around, man, I spent a lot of time on Twitter, particularly Twitter, talking about stuff that I've never had a conversation with an institutional investor about in the, I don't know, 4,000, probably 4,500 meetings I've had in my 13, 14-year career. And so, trying to bridge that gap between, for lack of a better word, stuff that actually matters between
Right.
stuff that's being debated, in our opinion, compressing that spread and ultimately bringing the largest number of investors into this sort of institutional thought process, to me, is a real passion of mine. And obviously I can tell it's a big passion of yours. On that,
Yeah,
what do
sure,
you,
for
yeah,
sure.
go ahead. Absolutely. So what are you thinking? So just in terms of what you're seeing through your lenses, from an analytical standpoint, what are the kind of the most important developments in your space right now? And obviously your space is pretty broad as a global macro guy.
Yeah, I think the thing that I see today as we sort of look into 2023 is we're entering a period of what I'd call what looks like transitory Goldilocks.
Mm,
And the reason why I say that is because we've had, if you think about over the course of the last 6 months, we've had a bit of easing of financial conditions. We've had inflation coming down. We've had nominal incomes in general continue to grow at a moderately good, somewhere between moderately good and kind of good, pretty good pace.
yeah.
And that creates an opportunity to continue to spend, particularly in real terms, over the course of the next, 3 months, 6 months, something like that for households. Demand is still okay, so businesses are probably not going to be cutting back. The labor market is reasonable. And so you kind of have this picture where it looks like growth looks okay to good. And on the margin, like Europe not being a disaster is a good thing for the global economy. China opening up on the margin will be good for the global economy. And so things look kind of
Mhm.
good from a growth perspective. And we've got a goods disinflation that's happening. That's the function of the resolution of the various supply chain issues, where we had inflation go from too high, clearly too high. Now it's starting to actually be a disinflationary impulse. At some point, that will then start to come back. We're already starting to see that with things like used auto. The rate of declines in used auto prices is starting to slow. Take
Mhm.
that and think about that, but that really helps you understand. And so we're going through the cycle of
Positive third
inflation.
derivative, negative second derivative.
But that's the thing that matters for inflation is the pace of the declines is the thing that matters.
Mhm.
Or a slowing pace of declines is actually a positive impulse on inflation. And so what we're seeing here is kind of uh, the maximum or the best low inflation moment that we're going to see, and reasonably healthy growth, moderate fine growth, secularly tight labor markets. And so it looks like Goldilocks. It looks like has a whiff of soft landing. But what's happening out there in the market is that, first of all, the fact that we're going to get that means we'll extend the cycle, which will increase the inflationary pressures, sort of core inflationary pressures, which have not been
Mhm.
resolved around wages and services inflation. And number two, you have a situation where that will then inspire the Fed probably to need to run tighter than expected monetary policy. You put those two things together relative to what assets are pricing in the bonds and the stock markets, and it's still too early probably to go long, to go all in on 60-40. This is not the time to go all in on 60-40. You're probably seeing something a bit illusionary that will not continue to play out in the back half of 23. And so that's kind of the sort of transitory Goldilocks is kind of how I'm naming it right now.
Your former colleague Andy Constant over at Damp Spring has a great a quote on this. We had him on the program a couple of months ago, and he called it the immaculate disinflation. Which
the immaculate disinflation. Yeah. He also this morning he said getting to hard landing is like going to Australia. You have to stop in Goldilocks Island, just the way you have to stop in LA to get to Australia.
Yeah,
before you get to hard landing.
That's a great analogy.
He's kind of like, that's what we're doing here is we're stopping at Goldilocks Island along the way to hard landing. So anyway,
and so you're a student economic history, former sort of professor within Bridgewater's confines. Why is there even an immaculate disinflation? Why can't we just disinflate and avoid a recession altogether? What's the historical evidence in your opinion on that?
Well, I think it comes down to the labor market, and I think it's interesting how it feels like people are quickly suggesting that these sort of tried and true ideas around what the connection between labor market and wages, that they're just kind of dismissing those as if we're in some totally different reality. Like if labor markets are tight, wage growth is strong. Right. And there's upward pressure on wages like that. And that is true, across hundreds, thousands of years. That's true across all countries. Like this is not like at some level, like not that novel a concept. Yet when people look at the unemployment rate and they're like, well, I understand it's secularly low. And, we've got all sorts of difficulties filling jobs, particularly in the service sector. And so therefore, but it's all going to be okay because wages are just going to go down. Like it's like saying, gravity isn't going to exist, right? Like you're pushing against fundamental realities of how labor markets work. And so I think that's really the core of it, which is we can resolve supply chains. Although that resolution is mostly behind us rather than ahead of us. And, there can be, short-term, some commodity, they can draw down the SPR to help supply commodity prices or get Iran to put a few more barrels of oil on the market. But that market is basically tight and the rest of the commodity markets are basically tight. And so you have this, and you can have some of these transitory things, but the way that you sustainably bring down inflation is by weakening the labor markets. And so far, if you look at what's going on, there hasn't been enough of a tightening pulse into the market in order to ease the labor markets, in order to deteriorate earnings enough so that people want to start laying people off. There are no indications that that's the reality. There's indications that people might be gloomy. They might say that they're upset, things like that. The soft data, is a little weaker. But it hasn't been that tightly related to actual activity for 15 years. And when you look at actual activity information, actual spending, actual, production, like the actual real data, what you see is the economy's fine. It's like putzing along okay. Manufacturing's a little soft. That's okay. It's pretty tiny. The real estate market, basically you had the excesses blow off, but there's still a lot of secular underinvestment, and so you're continuing those projects take a long time to work through. There's a lot of multifamily. It's going to take, the idea that it could take another year before you start to get real declines in the housing market. In the I should say residential construction market is pretty reasonable, and we're seeing some slowing in the pace of declines there. And so you get this situation where it's like the economy's going to be just kind of plodding along, for a little while. And that's very much in contrast to the FUD that's out there, the FUD purveyors who want to
What is
get you
define
to
FUD for our audience?
what fear of uncertainty and doubt or something like that. It just
Yeah,
means
yeah,
like, people saying that things
yeah.
are going to be terrible, right? Fear, uncertainty, and doubt. Just people who are just talking negatively about what's going on in order to drum
Mhm.
up fear about the fact that a recession is imminent. And
Yeah.
and it's hard. It's hard when you go engage out there in the outside world with that type of thinking, because it can feel so immediate and critical to know and understand, and will affect things so immediately. But actually, what like that's the problem. That's the problem with this cycle, is it's actually very slow and pretty boring. And that
Yeah.
is very hard to convey on Twitter. It's like, I think that things will plod along moderately for an extended period of time. It's like, gets like 1,000 views on Twitter, versus I think recession is imminent, gets like 1,000,000 views on Twitter. But one is fact-based and one is basically click.
100%. I see it in my own research. I can see it in the responses I get to our own published research. When I say, hey, look, I don't think we're going to recession until probably Q4 of this year, people are like, but yeah, didn't you just see the ISM services? Didn't you just see this data point or that data point or this survey or whatever? And look, that stuff all matters. I think it's part of the Bayesian inference process that we're all engaged in with
Right,
respect to,
right,
okay,
exactly.
are we on the path to recession? Sure. If I got data that said we're not even on the path to recession, then I'd have to revise the original view and push that out further in time. But I do believe, for a variety of different reasons, that we're on that path. You had a great point in terms of Colin. If you bring this chart up on the screen, this is actually one of my favorite charts from our January macro scouting report, where we sort of kind of walk through the progression, the sequence, if you will, with respect to private sector wages, and we're using within the BEA report, the PCE report, we use the nominal employee compensation statistic as a proxy for, a broad proxy for wages in the economy. And what the red bars in this chart show the 3-month annualized rate of change of that metric. The blue line shows the year-over-year rate of change of the metric, and the black line is a proxy for the Fed funds rate, using the 3-month T-bill as a proxy for that. And what we find is that, if you look where the black dotted lines, the vertical black dotted lines are in each cycle, that's when the 3-month annualized rate of change really starts to break down, specifically below the Fed funds rate. That itself tends to be a leading indicator for significant deceleration in the year-over-year rate of change that we observe in the cycles. And as you can see, just by the location of the black dotted lines relative to the red bars, you typically have to be just on the precipice of recession or already in recession for those wages to really come decelerate in a material
Right.
fashion. And to me, that's the big risk, which is, hey, look, the Fed's got to tighten us into a recession if it wants to achieve its inflation objectives. And there's been no indication, particularly once we got that hawkish pivot, which we believe occurred in December, there's been no indication since then that they're going to relent on that goal. And so ultimately, I think you and I are probably in agreement that we're going to have to take the over on rate hikes in 2023, both with respect to actual rate hikes, which will come in the first half of this year. I think they'll probably get to 5.25 or 5.50 at the lightest, and with respect to market pricing in the second half, because it's unlikely, in our opinion, that they're going to be in a position to cut interest rates by the end of this year, just based on the timing of recession and ultimately the time it takes to see some of these disinflationary processes play out. Do you have any different thoughts on that?
No, I think that first of all, like, um, I hope people appreciate just how good this stuff is. Like,
Oh, thank
this
you.
is like, it is awesome to see the pile of charts, the quality of the, like, you're looking at 60 years of history. There are not a lot of people in this business, who, even people who are running serious money, who go through this level of rigor. And so, like, mostly just as like a person who appreciates high quality work and analysis and
Likewise,
thinking in
man.
this space, like, this is a real gem. And he didn't
Thank you.
even pay me to say that. It's just, it's just my,
That means a
it's
lot,
just my
man. I appreciate
reaction
it.
to it, which is great.
No, thank you.
Um, and so I look at that, and I'm mostly with you, which is like this idea of slower movement towards a recessionary point is, I think, where my sort of base case is. And I think it's tricky because I think people often make that connection of, well, there will be recession, so I should buy bonds today, right? And
Mhm.
I actually think that caught a lot of people in December, and we're seeing a little bit here, a little bit in November and December. It caught people who saw those yields and started to buy because they thought recession was imminent. Like, because recession is imminent doesn't mean that there's going to be a bond rally. Like, if you look back through time, particularly in inflationary cycles, what you
Mm.
see is that the bonds typically start to rally when the Fed starts to ease. That's a very
Mm.
important thing, because in those cycles, the easing typically happens well into the actual recession. And so
Mm.
if what we're thinking is that the economy is more durable, right? We're sort of moderately plodding along for the next 6 months because things are okay. And then maybe fourth quarter we get into recession. And then maybe at that point, after a little bit of time, the Fed finally gets convinced that they've broken the back of the structural inflation issues. That's when you buy bonds. You don't buy
Mm.
bonds, you know, a year before that point. You buy bonds when you get to that shift. And so, in some ways, I think it's actually, I think people are overthinking it. It's like when the conditions are aligned with the Fed shifting to an easing policy, go buy the
Mhm.
bonds, right? And not until you get to that point. And so, what's priced in right now essentially is suggesting that the Fed is going to start easing. The conditions essentially are today, right? Because today aligned with easing, because it takes some time for the Fed to actually consume, like they have to actually get the reports in and look at them and think about them and then make a
Totally.
decision and then finally ease. And assuming it's not like a financial crisis, they don't have to ease right away. So it would probably take them a few meetings from the point in which the conditions are pretty clear to the point where they actually start acting. And so by pricing in cuts in the back half of 23, you're basically saying conditions today are aligned
Mm.
with the Fed shifting to easing. And that's not true. Like,
Yeah.
unambiguously not true. Um,
Just couldn't agree more. I think we're going to find a lot of agreement. So so I'm looking for charts to kind of play devil's advocate to our own views, which I think we very much share. Colin, if you throw up this slide on slide 33, where we show just the sequential momentum on leading indicators, coincident indicators, and ultimately GDP, and obviously leading indicators are falling off a cliff,
yeah.
right? We're at minus 10% 3-month annualized in terms of the conference board leading index. We're now starting to see that weakness filter through just coincident indicators. We're now slowing to an kind of at trend pace, if you will. Significant decelerations in the last month in terms of our monthly nominal GDP and real GDP statistics. And so there's some view out there that, hey, look, we've had this massive acceleration in policy tightening relative to historical cycles. So much so that if you look at the this blue line in this chart shows the real 10-year yield. We take the 10-year nominal yield and inflate it by the Cleveland Fed's inflation expectations index to give us a long-term time series of real interest rates. And historically speaking, when you've had these massive shocks on a trailing 3-year Z-score basis, we've always had significant slowdowns in the economy. Many of which have obviously led to recession. This has been the most significant shock in terms of that real yield metric that we've observed. And so there is this view out there that based on leading indicators, based on the speed of tightening, and based on a variety of other things that you and I may disagree, may agree that don't really matter, but we have to entertain them for argument's sake. There's a view out there that says, no, 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 no. Look at that ISM services PMI. We're going to
Right.
be in recession very soon. Buy bonds, perhaps buy stocks as well, because the Fed's about to pivot. What do you think about all that?
Well, I think if you leave that chart, I think it's actually pretty neat to see um, the business of of thinking of using macroeconomic understanding to then trade markets requires two important components, which is the
Mhm.
first is to understand in particular the leads and lags in the economy, to
Mhm.
understand what's likely to transpire in the future. And the second is to look at what's priced in and compare that to what's likely to happen in order to get a view on markets, right? That's what you need to do. And so I think this chart's actually pretty interesting, because what you see is the lag between the moments in which that indicator, the blue line ticks up. There's a lag between that and when you get an economy that gets into recession. And that's an important thing. And that lag is not months, it can be years. Like particularly if you go, I mean, look at the 08 cycle, it was years. Look at the 2000 cycle, it was a year or so. Look at the if you go to the 90 cycle, it's that way as well. If you go back into the 70s cycles, it's that way as well. And so what you see is it takes time for these things to play out. From the Fed says long and variable lags, and it's just really important to recognize there are long and variable lags. Right?
Totally.
And that's such an important thing to take into consideration. So just because even there has been a reasonably significant amount of tightening, and we are, as you say, we are on the path to a recession environment, doesn't mean it can't take 12 or 18 months more to get there. And that's not good enough to trade markets, because what's priced into bonds right now is essentially immediate recession. Okay, well, that's a disconnect. At the same time, what's priced into stocks is everything's okay. Probably not true either, right? It's probably not an immediate recession, and it's probably not everything's okay. And so you put those things together, and that's kind of how it's like this muddling through with transitory Goldilocks that is neither priced in the stock market or the bond market, which actually, unfortunately, makes both assets not that great to hold during this period, even though the economy is kind of doing okay, and even though inflation is coming down. And so that's kind of that's tricky. Like I'm telling you, I've been doing this for 20 years. Like that is a complicated set of things to like wrap your head around. But it's kind of what you have to do in order to be able to navigate effectively through this period. I'd just say one last thing on the leading indicators and things like that. There has been a basic view for a long time that there's an order to how things work, which is rates rise, housing deteriorates, manufacturing deteriorates, and the core of the economy deteriorates. That has been mostly true, but that has been mostly true in the context of credit cycles, not income-led cycles. So that's the first thing. And it's been mostly true in the context of I'd call orderly macroeconomic dynamics that aren't being screwed around with by, frankly, like supply chain shortages and COVID and all that stuff. And so what we're seeing today is a big reliance on thinking that manufacturing, which is tiny in the economy, is going tiny part of the economy, irrelevant part of the macroeconomy, is leading what's going on. But actually, you've seen services demand and manufacturing demand or goods demand, those have been negatively correlated post-COVID or since the start of COVID, right? Huge demand for goods, then that starts to fade. Terrible demand for services, that starts to rise. And that's confusing the heck out of people, right? Because they're seeing something that typically leads, even though it's tiny, it leads, but it's negatively correlated to the thing that matters in this cycle. And then the last thing I'd say is there's a whole set of issues related to surveys, which I think we're best off recognizing we don't fully understand why surveys have deteriorated in quality relative to how good they were prior to the financial crisis. And so I just wouldn't run out and say, well, a survey says it's bad. Like I listen on Bloomberg and someone says the US services economy is in contraction. And it's like, there is no real data that says the US services economy is in contraction, but because some random survey, like frankly, random survey that's been zero correlated to services demand over the last 15 years, zero correlated, because that is negative. Someone just says, as if it's a fact that the services economy is contracting. It's just not true. Like that's not based in reality. Sorry, I'm getting fired up about ISM not manufacturing.
I'm trying to keep you from getting fired up because I'm getting fired up with you. I've done all the math on this stuff too, and look, they're great indicators because they tell you what everyone else thinks, right?
That's
they're
true.
Not great indicators for telling you what is happening. And so
Right.
that's part of the process of, remember your 1-2 combo on understanding macro and using it to predict markets. Part of that discussion is understanding what everyone thinks and what's ultimately priced
Absolutely.
in.
Right.
Yeah.
And part of the bond market strength is because there are people who are looking at that services PMI and saying it is a fact that the services economy is contracting, therefore we are in recession. I mean, I'm sure if you go on Twitter, you'd get, you can find plenty of people who will tell you that, like literally
100%.
word for word, right? And show that chart, but they won't show that chart against the actual benchmark information. That's a good indicator, by the way, of good analysis versus bad analysis. Are people thinking about what the thing claims to say relative to what it should be saying? What's the benchmark to assess the goodness? That's why I love all these charts, because there's just like a lot of great richness and analysis that's critical. You can't just look at a chart and say it's truth. You have to wrestle with things like the signal versus the noise and the goodness of it, because that's what you have to do in order to do this well.
Yeah, and it's not easy, man. I mean, you said you've been doing this for 2 decades, and I'm in my 14th year, and that's 34 years of doing this. And I've never been personally more confused about the different cross currents. I've been writing in my research. I've been calling it violent cross currents. They are violent.
Right.
There's a belief out there that the U.S. economy is at or near recession. There's a belief out there that we're having an immaculate disinflation, and the Fed is about to pivot, and everything's going to be great, extend the cycle. And then there's also, what's happening abroad. We haven't even talked about what's happening abroad. What's going on in Europe, what's going on in China. I happen to think China is the bigger deal right now. Any thoughts there as it relates to the reopening, the stimulus, and ultimately how it may impact markets?
Well, I mean, part of the story is, China's been in bad shape for a long time. I think shifting from closed and in bad shape as a result of the closing to open will probably, the probabilities are skewed to better than terrible in the Chinese economy, which would be a positive growth impulse globally. I think I think we should all, though, recognize there's a very wide range of what that means. That could mean anything from, a bit better than terrible to booming, could be. And so the idea that China grows over the next year 3.5% or 4%, or they grow 6 to 7%, I think both are totally plausible outcomes. And there's a lot of uncertainty about it. It's a good example, though, of where you connect that understanding to what's priced in. So you then go look at what's going on in commodities markets, and you see basically, if you just take a very simple, well-diversified commodity ETF like BCI, let's say, which is just, a balanced portfolio, it's basically back to where it was in January 2022. So it's pricing in very low commodity inflation. The commodity markets are pricing in very low commodity inflation in a time when you have an impulse here. China in January 2022 was very different than China today, yet the pricing is essentially the same. And so I see the dynamic as uncertain, but particularly when you look at the commodity side of the world, the pricing in is of poor conditions. And so you put those two things together, and I think there's a decent skew to the upside. Is it certain? By no means, it's not certain, but I think there's a good bet in there related to the China opening that also happens to be a bit negatively correlated to things like thinking that there's going to be increased Fed tightening, as an example. Like commodities would typically underperform in a Fed tightening, but they've got these structural pressures, which means that they might outperform even if the Fed's tightening. And so there's a nice, from a portfolio construction standpoint, there's a nice balance there in that portfolio that, because you're always in running money, you're always trying to look for trades that have a little bit of edge and that are lowly correlated to your other views. Those, if you could find, a 60-40 edge, if you can find 5 trades that are zero correlated that have a 60-40 edge, you will be one of the best asset managers in history. So like, think about that. Consistently do that. Right. I mean, that's, that gives you a sense as to what it is. That's what it takes, is doing that day in and day out and having the discipline to do that. But that's hard because, you may find positions or hold positions that may not align with your modal outcome, right? Your modal projection, but are still good risk reward trades in the context of the other positions that you have on in your portfolio. So anyway, that's a long-winded way of saying China's reopening seems mispriced or underpriced in the commodities market, and that seems like a good bet, particularly if you think that monetary policy is going to tighten in the U.S.
Excellent discussion, man. The last thing I'd add on that is, when we think about portfolio construction at 42 Macro, I think there's two things that I think we force ourselves to do, and learning, some of those things from your former shop and other great investors in the space, which is be diversified across not just your modal outcome, but across the entire spectrum of probable scenarios, meaningfully probable scenarios, not just, rocket hits my house or whatever. but so obviously, understanding the full distribution probable outcomes and allocating according not only to the shape of that distribution, but also tweaking as you go along as the distribution itself shifts based on new information from our Bayesian inference process. And then the secondarily is understanding that not all the trades have to work at the same time. You can use the calendar. You can be long as much China as you want in this process, in this period of time. We haven't even talked about it. I don't know if we have time, but in this brief period of time where, the liquidity function, both domestically and globally, is actually not deteriorating. That's allowing capital allocators to lever up and shadow banks, et cetera. And, this will allow a place like China to actually, meaningfully recover from an equity market and sentiment standpoint. But that doesn't necessarily mean that you want to be levered long China or commodities or anything like that, heading into the market actually accepting the fact that the Fed's going to be tighter for longer into an economy that needs a lot more, body blows, if you will, from Fed tightening in order to create the inflation outcomes, the sustainable inflation outcomes that the Fed is highlighting. I think you and I probably share this view before we turn over to questions, which is, there's this belief that the Fed has already done enough, like stop, slow down, chill. You've done enough. And that may be true with respect to getting, core PCE to, transitorily kiss 2% inflation by the end of the year.
Right.
But that can't possibly be the Fed's goal, because if they kiss 2% inflation, we're going to reaccelerate from 2 to 3 or 4 in 2024. Right. And I keep trying to explain that to our customers. It's more than just this business cycle. The Fed has to get the labor market back into line so that we are consistently generating something at or above 2% inflation on a consistent basis, not just to satisfy the request of market participants in 2023.
Right. Exactly. Yeah. Oh, it's totally right. And I think the overall, the thing that is the challenge is holding all of these connected realities together at the same time, which is that we probably will get to recession. It will probably take some time. It is, priced incorrectly into, it's priced differently in the stock market than it is in the bond market. That changes the way that you think about those two. It's important to think about those two assets. You don't need the timing, right? Like, if you position for recession today, you may have a year of terrible outcomes along the way. Like, that is tough to hold all of those things in your head and then take in the incremental data, evaluate the quality of it, and see how it marginally determines how you're thinking. But that's like, that synthesis that you just gave right there is the thing that is necessary to navigate a challenging market environment. It is not like put a line on a chart and say, this is just how it's going to be. It's so easy. You just, whatever, recession's here, buy the bonds. It's like 200 pages of rich macroeconomic triangulation to understand what's going on in order to have a bit of edge across a set of positions over the course of the next, 6 months, and then continuously be updating that understanding and thinking about it incrementally along the way. It's not, it's just like a lot more, in some ways it's like a lot more complicated and boring, but it's what it takes to run money.
It's boring. Going back to what we started with, which is unlimited funds and the concept of 2020 and generating consistent returns. Managing money should be boring.
Boring, yes.
It should be boring as hell. If you're having too much fun, you're allowing yourself to be instructed by all sorts of behavior heuristics that are not good for generating
Right.
consistent returns.
Oh, it's totally right. Totally right.
Absolutely. So I know that customers are probably listening to me laughing because I'm sure I put many of you to sleep with our macro scouting reports and whatnot. But guess what? It's on purpose. It's for a reason. So, Bob, before we let you go, I had a few questions from the audience, if you don't mind.
Yeah, for sure. Anything.
Absolutely.
On
So
people's minds.
we'll be rapid fire here. So Tom is said thoughts and probabilities on a Q1 to Q2 rally based on observations that the yield curves are bottoming, and which will allow us to see one final hurrah before the downturn comes.
Well, I think that is a real possibility, and I think that is, I might have used some strong language on Twitter, but that could really mess with people's minds. I think, right, that we could have people see a transitory Goldilocks scenario, and that would create a desire to lever up right into the need for the Fed to be tightening. I think that all these things are connected to whether or not what your time frame is, right? If you're trading, if you think that you can create alpha and you can trade tactically on day to day, then you should consider that. If you're most people who are developing, diversified portfolios of strategic asset allocations and trying to manage that prudently, like it matters a lot more that the Fed is going to have to tighten more. And so you should just prepare yourself for that scenario, over a longer term time frame, because that's the thing that's going to drive your returns over the course of the next 6, 12, 18 months.
100%. Appreciate that. Craig's asking, market pricing. The market is pricing in an aggressive rate cut cycle that runs counter to your and both of our really more constructive economic outlook relative to the consensus on a recession, near-term recession. Why doesn't the Fed push back against this more aggressively? Do you expect them to?
Well, I mean, heck, I don't know how much more they could push back. I mean, they're literally sitting there going, the market will be wrong. Like multiple Fed governors are going out there saying the market will be wrong. I think, maybe people are calling their bluff. The market's calling their bluff. And I think that people are going to learn, like, there's this strange old adage that you shouldn't fight the Fed, but everyone in the market seems to be fighting the Fed in a way that is, odd. Like I would have thought we would have learned last year, like, don't fight the Fed. So that's, I think they're doing, certainly they're giving about as much guidance as they could plausibly give. And at some point the rubber will meet the road and they'll just keep doing what they need to do and people will be surprised.
Absolutely. And one thing I'd follow up on that question in terms of the market fighting the Fed, I think with respect to why they're fighting that, because I think you and I both agree that it's pretty ridiculous. The market, sort of basically spitting in the face of the Fed, if you will. But I think part of the reason for that, Colin, if you throw a slide up where we show our positioning model, the market is if you look at net non-commercial net length as a percent of open interest, which is our metric that we track within the CFTC data, which again, I think you and I both agree it's not great data, but analyzing it in rate of change form leads to conclusions. And one of the conclusions is that we're basically at very low levels of non-commercial net length, i.e. negative in most, risk parity type assets, 10-year, 2-year, NASDAQ, or not NASDAQ, but S&P, Russell, basically long bonds, et cetera. And so you have a whole entire institutional investing community that is, effectively underrate right tail risk. At the same time, if you go to slide 8 here, where we show the components of our net liquidity model, specifically with respect to the Fed's reverse repo facility balance, that thing's at $2.2 trillion. That's basically $2.2 trillion of QE waiting to capitalize global financial markets if and when there's a legitimate signal either on the growth front, sustainable signal on the growth front, or a legitimate signal on the liquidity side from the Fed. I don't think we're anywhere close to either of those, but I think we understand the sort of institutional insecurity around people's willingness to fight the Fed and kind of speculate on upside, because they ultimately know once that upside starts to come, they're going to get left behind. Absolutely.
For sure.
Cool, man. So this has been a phenomenal discussion. I just want to say I really can't thank you enough for your time. My final question that I always have for our guests, which I think I learned. I learned the most from this kind of question, because I tend to like to learn like how to do the job as opposed to what I should be looking at. I think that's the easier part. What is the number one risk management lesson that it is so core to what you do now and today? And it might not even just be in finance; it might just be broader in life. But hopefully, with respect to finance, that you know now, and it's so core to what you do today that you wish you knew your entire career.
Well, I think the biggest risk management lesson is that I hold every day is that you're not as good as you think you are.
Agreed.
And so I think that's so critical to recognize, so that any of your intuitions that you think are true are not as good as you think they are. Any of your, eh, frankly, like your ability to generate proprietary alpha is not as good as you think it is.
Agreed.
And so the key thing when you do that, when you appreciate and understand that, is you appreciate the value of diversification.
Mm.
That's really what it's all about, because you recognize that even if you're great in the macro space on any one trade, you'll be 60-40 right over a 1 month time frame. And so, that means wrong 40% of the time. And
Yeah.
that if you're 60-40 right over a 1 month time frame, you are among the top, 10th of 1% of investors in the world, right?
You're a
Just like
legend.
have that in mind. Which
Yeah.
means in this conversation, 40% of what we've said will be totally wrong. Totally and completely wrong.
100%.
Right. And so you just have to prepare yourself to not be nailed if you're wrong, right? That's what you got to do. You want to be in a position where you're flipping coins slightly weighted in your favor over and over and over again. And if you can do that and build that diversification and the time and the risk controls, you'll come out okay. But if you overweight your own discretionary views and you put all your eggs in one basket, like you're going to blow up, you're going to get destroyed. And it's actually one of the reasons why I was so interested in building the unlimited product, which is, diversified, low cost index funds for 2 and 20 strategies, is because I am more confident that the entirety of the hedge fund community together and their insight will generate more consistent returns than I can myself
Mhm.
or a company I build running a proprietary book. And that's pretty interesting, just like think about that. Like I have run money at the most sophisticated institutions in the world. And I recognize that the wisdom of the crowd, a diversified set of portfolios, a diversified set of strategies, that will be more consistent over time than me myself. And that really, when you think about a risk management strategy, that is my risk management strategy, which is diversification.
Brilliant. 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 It's so funny you said that, man. I tweeted the other day, maybe in December. You guys, we had a great year last year. I'm not going to make bones about that. And I was trying to caution investors from saying, I was like, hey, look, we had a great year last year, but look, you should always haircut at least 40%, probably 45%
Right.
of the stuff that comes out of my mouth as just going to be wrong. This is the nature of the beast that we're operating in from a risk management standpoint. And once I think we understand how to do that for ourselves as investors and appreciate the value of diversifying across themes, across managers, across strategies, and ultimately, appreciating that, just understanding, hey, look, some of these trades are going to be wrong, and once we
Right.
understand that, we start from a better place in terms of that
Yes.
Bayesian inference process that we
Yes, totally,
discussed.
totally. And people get so confused, like they get confused by confidence, meaning insight, and that is totally wrong. The more confident the person is who's talking, most likely the less insight that they have, right? And the more triangulating, data driven, uncertain, wrestling, holistic, that is the path to insight and success and winning durably over time. And people get confused by those two things because one looks really good and one is really good.
Bob, this is such a bro fest, and I'll let you go after this. But Colin, can you put up
Yeah.
our deck back on the screen? Because this slide here is at the end of every one of our presentations, and it just shows it's literally exactly what you just said. It's from Danny Kahneman's book, Thinking Fast and Slow and Thinking Slow. And, it's like subjective confidence is a judgment, or sorry, subjective confidence in a judgment is not a reasoned evaluation of the probability that this judgment is correct. Confidence is a feeling which reflects the coherence of the information and the cognitive ease of processing it. It is wise to take admissions of uncertainty serious, but declarations of high confidence mainly tell you that an individual has constructed a coherent story in his mind, not necessarily that the story is true. And so
that's funny.
As unconfident as you and I sound about the outlook and about where to go from a financial market standpoint, we are placing our bets, yours in diversification, ours in our diversified risk management process, and we look forward to reconciling that later this year, my friend. Appreciate you.
Yeah,
Your insights are fabulous.
Great.
You're a great guy. You're a great addition to this community that we are all participating in. So just want to thank you for joining us, Bob.
Yeah, thank you so much. And for those of you who I haven't, talked to before, you can follow me at Bobby Unlimited on Twitter, or check out what we're doing at Unlimited and our blog and stuff, which is all in that Twitter that Twitter bio. So check it out, follow me, see all my uncertain thoughts about what's happening.
And by the way, it's just a shameless plug for HFND. I spend a decent amount of my time with our Pro subscribers, helping them construct portfolios for their clients. And one of the big questions that keeps coming up is, everyone's got basically too much cash right now, right? If you did well last year, it's probably because you raised cash. And now
that's definitely true.
Managers are getting antsy. Portfolio managers for investment advisors are getting antsy because their clients or their motherships are telling them you got too much cash. And so definitely at the bare minimum, HFND is going to be one of these products that should deliver you, returns, but at the bare minimum, something that has a lot lower beta to a significant negative market left tail event in the market. So definitely go check out HFND when you guys get a chance.
Yeah. And if anyone, wants to get in touch, you can contact us through the site, and we're always here to pick up the phone. That's the day job.
That is the day job, brother. Well, I appreciate you guys. Everyone be good.
Great. Thank you so much.
Cheers, brother.
Talk to you later.